Market View Presentation by Simran, Mohammed and Cedric from Stream 8, Group 9.
Australian dollar versus the US dollar. Relative inflation rates. According to the RBA, the Australian inflation rate is at 1.9%, whilst America's is at 2.12%, according to inflation.eu. USA's inflation rate is higher than Australia's, which means their dollar would lose purchasing power at a higher rate than the Australian dollar. This will mean the AUD would appreciate against the USD. Another effect of USA's higher relative inflation rate would mean their goods and services would be more expensive than Australia's goods and services, hence less attractive to the rest of the world. This will mean the exports of America would decrease compared to Australia's. Also, America's imports would increase because of the relatively cheaper goods and services from overseas, and Australian imports would decrease because domestic products will be relatively cheaper than foreign products. This will cause more demand for the Australian dollar than the American dollar, and less supply of the Australian dollar than the American dollar. So hence the Australian dollar would appreciate against the USD, as illustrated in the diagram. Relative interest rates. The RBA website states how the Australian interest rate is at 1.5%, whilst America's, based on the Federal Reserve of USA, is at 1.16. Firstly, we can establish that the higher interest rate of Australia is not relatively affected by the inflation rate because the inflation rate is lower than that of the USA. As for the interest rates, both are low, but the interest rate of Australia is higher than that of the USA, which means more investors will be likely to invest their money in Australia than the USA. So the increased cash inflow for Australia and higher demand for its dollar in contrast to America. Also, this would discourage capital outflow for Australia, which is due to a relatively higher rate of return domestically, which means relatively decreased supply of Australian dollars. Therefore, the Australian dollar would appreciate against the US dollar. Relative economic growth. Australia's economic growth is at 0.8% according to the Australian Bureau of Statistics, whilst America's is at 3% according to the Bureau of Economic Analysis. This will mean that Australians will be more worse off financially compared to Americans and buying less imports from overseas, which means less supply of Australian dollars. This will mean the Australian dollar will appreciate against the US dollar. But on the other hand, Australians will see less investments being made within Australia due to a slower rate of economic growth, which means less return on an investment for the investors in contrast to America. This will mean less demand of Australian dollars compared to the American dollars, and hence the depreciation of the Australian dollar against the US dollar.
Relative government intervention. US's President Trump trying to encourage companies to stay in the United States instead of moving offshore. He used the tax power of government by warning the companies who moved offshore of 35% tax. This will mean that some of the companies may decide not to go offshore and stay in the United States and help the economy to grow by employing American residents. On the other hand, if companies stay in the United States, the companies' costs will increase due to higher wages in the United States, and if they move offshore, they will pay higher taxes. This will be costly for USA because companies will pass on the cost to consumers, and hence we will see a rise in goods and services prices, which means a rise in inflation rate for them. First effect of Trump's action: higher economic growth. This will lead to more imports, increased supply of USD, and hence depreciation of US dollar against Australian dollar. But due to more borrowing of local businesses, which means more demand for USD, the USD will appreciate against AUD, as you can see in the graph. Second effect of Trump's action: higher inflation rate. Less attractive goods and services compared to Australia, which leads to relatively more demand for Australian goods and services. Australian exports relatively increases, so demand for Australian dollar will also relatively increase. As for imports, Australians will relatively decrease their imports because of cheaper domestic goods and services compared to Americans, who find their domestic goods and services more expensive than buying them from overseas, so hence their imports relatively increases. Both relative exports and imports will result in AUD appreciating against the USD, as you can see in the graph again. Past exchange rate. From July 14 to January 16, we see constant depreciation of AUD compared to the USD, but since then, the AUD on average has been appreciating at a slow rate against USD from around 70 cents to 80 cents of US dollar. From the analysis of macroeconomic indicators and past exchange rate, we see Australian dollar appreciating against USD more than depreciating. So hence I predict a very slow appreciation for the Australian dollar compared to the US dollar for the next 3 to 6 months.
So now we're going to be talking about AUD versus JPY. Just a little overview of the currency. JPY is the third most commonly traded currency in the world after the US dollar and the euro. It's the most heavily traded currency in Asia and is also used a lot in carry trades with Australia and the United States. After World War II, Japan actually had a fixed exchange rate with the United States, and it wasn't actually until 1973 that they switched to a floating rate. AUD is the fifth most commonly traded currency in the world. It is a commodity currency based on the fact that Australia has a substantial amount of raw materials exported from the country, and this currency is also used in carry trades with Japan. So the first indicator that we're going to talk about are relative inflation rates. So as you can see, Australia's is 1.9% and Japan's is 0.4% as of July 2017. Just below there's a graph just indicating the trends over the last couple of months on these relative inflation rates. So since Australia does have a higher inflation rate than Japan, it will experience less demand for exports. This will result in less demand for AUD altogether. There will also be an increased demand for imports, which will result in a large supply of AUD, as you can see in the graph when the supply curve shifts to the right. The Japanese inflation rate has been at a steady 0.4% for the last 4 months, so there's not really much indication for change coming up in the future. The Australian inflation rate, on the other hand, has been fluctuating a fair bit over the last few months, but it has consistently remained higher than the Japanese inflation rate, so that is indicating that the Australian currency will be in less demand. And as you can see, that's just the trends on the graphs below of the inflation rates. So the next indicator that we're going to talk about are relative interest rates. Australia's is 1.5% and Japan's is a negative 0.1%. As you can see in the two graphs below, they've been fairly steady. So empirical evidence does suggest that high interest rates generally result in depreciation. So when comparing the relative interest rate of AUD to the relative interest rate of JPY, AUD has remained constantly higher in this case. When comparing real interest rates to nominal interest rates, real rates are considerably more constant as well. High nominal rates indicate high inflation rates, as mentioned in the earlier indicator. This is attributed to a lot of the carry trade which goes on between Japan and Australia. But with Japan maintaining a negative interest rate, it actually means that investors will have to pay money to keep money in the bank instead of receiving interest on their payments. And in terms of loans, it means that banks will have to pay the borrower's interest. So for this reason, investors would favour the AUD as they would obtain higher returns on their investments. This would increase the demand for AUD, ultimately resulting in the appreciation of AUD against JPY. The next indicator that we're going to talk about is relative economic growth. So Australia's is 0.8% and Japan's is 0.6%. This is just a little history of the relative GDP growth rates for both countries. So as you can see, they have fluctuated for both of those countries. Higher levels of economic growth generally indicate an increased demand for imports, which leads to an increase in the supply for the currency. This will shift the supply curve to the right. Higher economic growth can also lead to an increased amount of overseas borrowing, which increases the demand for the currency, shifting the demand curve to the right. So both Australia and Japan have seen an increase in the GDP growth rate, which is indicating increased relative economic growth for both countries. Australia's is a little bit higher than Japan's though, so this could indicate an increase in the supply of AUD due to an increased demand for imports. It could also indicate an increased demand on the currency due to an increased amount of overseas borrowing. And the last indicator that I'm going to talk about is commodity prices. Commodities are just raw materials or primary agricultural products that can be bought or sold, which Australia is a major exporter of. So when the prices of the commodities do increase, the value of Australian exports will also increase, increasing the demand for AUD, leading to the appreciation of the currency. So as you can see on this graph from RBA, there has been fluctuation in these prices, but Australia has seen a slight increase in commodity prices in the past few months, so it will lead to an appreciation of AUD. So based on these indicators, we've determined that the yen, even though being a safe haven currency in the past and remaining stable throughout the years, we think that AUD will appreciate against JPY, also impacted by some of the current global factors that are going on. But based on the indicators that we had mentioned before, we do think that the Australian currency will appreciate against the Japanese currency.